the key message is that making money is one thing, and that's great. But being able to maintain it, multiply it, and enjoy it is something different. What we have found is that research shows that about 79% of millionaires didn't inherit a dime. And this first generation wealthy, what we call first gen wealth, people who made it themselves, have a different mindset. There are all kinds of things that befall them. They get the Waffle House hash brown life and FOMO and imposter syndrome. So there are a lot of psychological things to overcome. But what we have found and research shows is that those people who are successful, there are common patterns that are repeated over and over.
Uh, Let me just jump to what you just said, and then I want Matt to jump in afterward. What are the patterns? Can you just give me a few, heads up about those patterns we would all want to repeat?
Sure. I think the simple way to do it is the three superpowers are really the inverse of the patterns of failure. And the patterns of failure are the lack of a clear, compelling, magnetic vision of the future, the lack of a step-by-step concrete plan, and the lack of consistent execution. So the superpowers are the power of purpose, the power of plan, and the power of executing. And we see those patterns played out time and again.
Greg, or rather, Matt, you want to ask Greg a question about the book?
Yeah, I love it. I would love to know on the flip side, what are the biggest mistakes people make once they make this money to lose it or fumble it? What happens?
Yes. So one of the things that we see as a very clear distinction is it is typically mindset mistakes. How much can you spend? How do you invest? How much risk do you take? Those are really the big mistakes. How many people do you know that they've sold their company, they get a big chunk of money, and there is this temporary wealth effect, and they buy the car, they buy the plane, they buy the boat, whatever that is. Other events happen, they make a few investments that don't turn out, and next thing you know, they're not at the same place. Shockingly, about 1 in 3 decamillionaires, people with a 10 million net worth, will not still be there in 10 years. And we recently did research on the Forbes 400 list, and looked at it from 10 years ago. And there is about 44% of the people that were on it 10 years ago are not on it today. Now, some of those have passed. Some who has wealth that has stayed steady, even though asset prices have gone up, and some have declined precipitously. So you think about it, even billionaires aren't immune from this.
I want to pull a quote from the book because as we watch these markets go up and down, I keep hearing colleagues on financial news networks and people on just regular news networks talking about, well, the S&P 500 recovered. It never recovers the way people interpret that word. And you point out in the book, the larger the loss, the greater the subsequent recovery must be to break even. Very simply, if you lose 20%, you need 25 to 30% to get back to where you were. And in this current market, that's going to be hard. So this would be one of those mistakes a lot of us make as to why we don't diversify, or taking that knowledge that you have. How do I prepare for that?
Right. And so in markets like this, like Matt was talking in the last block, it's important to have some hedging. And so you can use alternative assets, you can use an alternative approach to existing assets, or you can use derivatives to hedge, whether you're doing buffered ETFs to, while it limits the upside, certainly limits the downside, or covered call strategies, which they help mitigate the downside and also create income that can be reinvested. But using those strategies, and what happens a lot of times when people see those declines, then they begin stretching on risk to try to get back to even. And sometimes that's not the time they need to be stretching on risk.
Matt, when we talk about stretching on risk and using crypto as part of this, because again, a novice when it comes to Bitcoin and crypto, but in the traditional sense of investing and maintaining wealth, how would you use a crypto strategy in the way that Greg is talking?
Yeah, I think the place crypto plays a role in that is in a small, focused allocation. The biggest risk in crypto, honestly, is one that we're sort of pointing towards, which is behavioral risk. It's adding too much and chasing prices when they go up and then panicking and selling at the bottom. More wealth has been lost in crypto doing that than in anything else. So when we talk to people about the value of crypto in a diversified portfolio, we're really focused on people allocating 1 to 5% of their wealth to crypto and rebalancing that on a regular basis. And if you do that, there's a possibility you will not make money, of course, in any investment there is, but you're constraining that risk. So again, I think a lot about behavioral risk when I think about maintaining wealth. And the way to treat crypto is not as something you can't touch, but something that fits in a certain place in your portfolio. But for most people, certainly isn't 30, 40, 50% of their portfolio because it is so volatile.
Greg, part of the book talks about the psychological aspects of these things. And I think we had a discussion at Fox years ago because my brother talks about this. The expectations you hit upon this is once you've made this amount of money, if some people will spend money thinking it's going to bring them joy, and it does for 30 seconds, but then you've raised your expectations. We have a guest who wants to ask you a question, Greg.
Greg, what are the top 3 indicators that you and your team rely on to begin repositioning your clients' investment assets?
Yeah, that's a great question. Because we are a quantitative technical shop, we use quantitative indicators. So we use a momentum indicator, how something is doing relative, for example, how Bitcoin is doing relative to the S&P 500 or to the bond index. We also use what we call a mean reversion indicator. And if you think about there being kind of a rubber band on asset prices, if they go up too far too fast, they snap back down. If they go down too far too fast, they tend to snap back up around a trend line. And we generally use a 31-week and a 31-day exponential moving average to help us establish those ranges. And then we use a directional strength indicator, which is really a supply and demand indicator. It measures speed and magnitude of price moves relative to time. The easy way, I think, to describe it is markets have some patterns that recur, not because Bitcoin is the same as the S&P 500 as the emerging markets index, but because human beings are involved. And so the technical indicators are really a way to measure how people tend to behave. So, for example, we know where we are right now with a lot of technology stocks, with the S&P, with the NASDAQ 100. We are at a tipping point where if they go down another 3%, there will be panic that sets in. And you saw that a couple of weeks ago with trading volumes, spiking at 4 and 5x. And that is a sign that human beings are voting with their pocketbook. And so we simply construct indicators that say, how are people probably going to behave, often poorly, in these scenarios.
Matt, I want to ask you about this risk that and fear factor that Greg just brought up, which is the panic element. My whole experience investing since the late 1990s up until now has been be patient, be calm, and I go through the panicky fear stuff that everyone has, but this time feels different because of the tariff uncertainty, because the global economic rules are over. They've changed. So how do you adjust right now without understanding where any of this could be going?
Yeah, I think it's really challenging. I do think that, this time is different. It's always difficult to mutter those words and be right? It's certainly COVID felt different and the global financial crisis felt different. And I know I more regret the trading actions I took around the GFC and around COVID than I do look back on them fondly. So my starting point would be to do nothing. But I do think it's reasonable for people to, to at least have a buffer of confidence and have some dry powder available to them that lets them sleep at night. Maybe if they think about 80-20ing or 90-10ing their portfolio and staying the course with the majority of what they're doing. But if they feel the need to scratch the behavioral itch, doing that in a small way that raises some fresh capital that they could deploy at lower levels, I think that's completely reasonable. But the old saying is, don't do something, just stand there, is I think a reasonable comment. That was one of Jack Bogle's favorite phrases, and I think it's generally served people right. But if you have to fiddle at the margin to make yourself sleep at night, I think that's okay as well. Just don't take wild swings. This is not the time, in my opinion, to do that, because there is so much uncertainty on both sides.
Greg, what are your clients? I mean, there is fear out there. What are they, when they call you, what kind of things are you hearing them say?
Well, I think the same kind of things any rational person who has had the news on, in the last 3 months would say. People are concerned. There is a lot of uncertainty. One of the things that we fall back to is, when in doubt, don't get out. And that having that bias to stay invested, to stay long, has served well. I like what Matt said. That's actually what we do. We have a strategic part of the portfolio and using a dynamic part, so that the human brain craves activity in times of stress. Well, somebody needs to do something. And so the question is, how do we do something? And the truth of the matter is, if we're all honest, everybody's a market timer. The S&P 500 committee times the market. They don't include all the stocks, right?
Right.
And if we have cash in our checking account today, we're probably timing the market, saying, I'm going to wait to put that in my account and invest it. So we all make some timing decisions. The question is, how are we doing that? Do we have a process that gives us some probability of success?
So, Greg, last question for you. And it's a quote from the book, which I loved. And it comes in when you're talking about FinPorn. Because having worked in traditional media, I know even at Bloomberg, at CNBC, they will throw up a chart sometimes, and it has some value to it. But the people creating the chart may not totally understand it. But hey, it looks good because it's got lots of numbers. And you talk about FinPorn, and you talk about, I think it was a Nobel-winning economist who wrote in the 1980s a book. And here's the quote: "I've kept a book in my office as a reminder for several decades." Quote, "The book is about surviving the coming Great Depression that will, without a doubt, occur in 1988 or 1989. Still waiting." That when I read that and I hear you say, panic, 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 hurry up and do nothing, I think you're addressing this issue about a very smart individual who predicted a depression which never came.
Yes, and it's I would make the distinction. It's okay to be educated. It's great to be educated. It's great to watch things, but to get to a point where you get all stirred up and there's a perversion of the knowledge that it's not really serving you, and that's what we call FinPorn. I think it's great to consume financial media and understand more what's going on, but when it gets you wrapped around the axle and gets you stirred up about making bad decisions, it's time to stop that addiction.